Most traders get in too late, exit too early, or fall for the same traps over and over again. But what if you could spot the exact moments when smart money steps in and use those moments to trade with confidence? In this video, you'll learn 10 powerful trading signals that actually work across Forex, crypto, and stocks. Here are the 10 game-changing signals you're about to unlock: the Fakey setup, Fibonacci golden zone reversals, moving average crossovers, Wyckoff spring, Wyckoff upthrust, Bollinger Bands breakout, Bollinger Bands reversal, the triple top, the triple bottom, and the stop hunt signal. Each one comes with clear examples and real trading logic, no fluff, no noise. So before we jump in, make sure to hit the like button, subscribe, and turn on the bell, because what you're about to learn can change the way you trade. Let's start with the first trading signal, which is the Fakey signal. The Fakey is a powerful price action setup where the market fakes a breakout and then snaps back in the opposite direction. It's designed to trap breakout traders and catch them on the wrong side of the market. Now let's break down the anatomy of the Fakey setup. First, the market forms an inside bar, a small candle completely inside the previous candle's range. Then price breaks out of the inside bar, tricking traders into thinking a new trend is starting. But instead of continuing, the market quickly reverses and closes back inside the inside bar's range. That's the Fakey, a fake breakout followed by a real move in the opposite direction. There are a few variations of the Fakey pattern you need to know. A bullish Fakey, where price fakes a downside breakout and then explodes upward. A bearish Fakey, where price fakes an upside breakout and then collapses downward. Sometimes the Fakey happens with 2 or 3 small candles after the inside bar before the fake breakout. This is a deeper trap that fools even more traders. No matter which variation you spot, the key is always the same. First, a fake breakout, then a quick rejection, followed by a strong move in the opposite direction. The Fakey setup is all about catching the trap before the real move happens. Look at this chart. As you can see, the market hit this level and reversed, forming a key level of support. When the price pulled back again, a Fakey pattern formed. A clear, smart money trap. After the Fakey, we can place our entry at the close of the candle that made the false break, set a stop loss below it, and target the next move. Now look at what happened next. As expected, the market moved in the targeted direction. Look at another chart. The market pushed up, hit this level, and reversed, forming a key level of resistance. It pushed up again, and as it approached the level, a Fakey setup formed. This Fakey setup is a smart money trap because the formation of the inside bar at this area indicates indecision. The breakout of the inside bar suggests that buyers are likely to push the market higher, but once the price closed back inside the mother bar, it confirmed the breakout was a trap. When this pattern forms, we can anticipate that the market is likely to move down. You would place your entry at the close of the candle that made the false break, set a stop loss above it, and target the next key level. Now, look at what happened next. As you can see, the market moved down and reached the next key support level, just as expected. Look at another chart example. Here, the market hit and reversed, then hit and reversed again, forming a clear trend line. When the market retraced once more, a Fakey setup signal formed. This signal indicates the end of the retracement and the beginning of a new impulsive move downward. You would place your entry at the close of the candle that made the false break, set a stop loss above it, and target the next key level. Now, look at what happened next. The market moved in the targeted direction. However, this signal is not a holy grail. Even good Fakey setups can fail, which is why proper money management is essential to succeed over the long run. Now let's move to the next trading signal, which is the Fibonacci golden zone reversal signal. Look at this chart. After a strong move up, the market started to retrace. When we draw the Fibonacci retracement from the low to the high of the move, you can see the pullback comes into the golden zone, which is between the 50% and 61.8% levels. This area is very important because smart money often steps in to buy from this zone during an uptrend. But again, you don't just jump in when price touches the Fibonacci level. You wait for a bullish confirmation like a strong bullish candle. Once the signal forms, you place your entry at the confirmation, set your stop loss just below the 61.8% level, and target the next resistance or the previous high. Now, look at what happened next. As expected, the market bounced from the golden zone and continued higher. Look at another chart example. The market made a strong move down, then started to retrace higher. We draw the Fibonacci retracement from the high to the low and notice something interesting. The retracement slows down right inside the golden zone, between the 50% and 61.8% levels. This zone often acts like a hidden battlefield where smart money prepares the next move. As price reaches this area, instead of breaking through, it shows clear signs of weakness. A strong bearish rejection candle forms, hinting that sellers are stepping back in. At this point, we have a high probability setup. You would place your entry at the close of the bearish candle, set your stop loss just above the 61.8% level, and target the next support level or the previous low. Now, watch what happened next. The market failed to break the golden zone and dropped sharply, following the path we anticipated. But, as always, even powerful zones like this one aren't foolproof. Some setups will fail. This is why using smart money management is not optional. It's what keeps you in the game for the long run. Next up, the moving average crossover signal. In this strategy, we use the 20-period simple moving average and the 50-period simple moving average to identify trend reversals and trading opportunities. Let's look at the first example. When the 20 simple moving average crosses above the 50 simple moving average, it gives us a buy signal. In this case, the crossover happened right after a consolidation phase, and what followed was a strong bullish move. If you entered the trade after the crossover and placed your stop below the recent swing low, the risk-to-reward ratio was massive. This is the kind of setup that can tilt the odds in your favor. Now, let's move to the next example. This time, the 20 simple moving average crosses below the 50 simple moving average, triggering a sell signal. If you shorted the market after the crossover and placed your stop above the recent swing high, the reward far outweighed the risk. These are the kinds of trades that get traders excited. But here's the truth that most people don't talk about. If you rely only on raw crossover signals, it's just a matter of time before your account gets blown up. Before I show you how to use this strategy the right way, let's go through the biggest mistakes traders make with crossover strategies so you can avoid them too. The first mistake is trading in a ranging market. This strategy only works well in trending markets. If the market is ranging, you'll get signal after signal and most of them will be false. In this example, look how many fake crossovers happened during the sideways movement. Every entry turned into a loss, and if you keep doing this, your account will bleed out. The second mistake is trading crossovers on lower time frames. Lower time frames mean more noise, more ranging markets, and more false signals. The crossover strategy was designed for trending environments, and trends are much more reliable on higher time frames like the 1 hour, 4 hour, or daily charts. On the 5-minute or 15-minute chart, you'll be trading in chop most of the time, and that's where most traders lose money. Now that you know what not to do, let me show you how to use the moving average crossover strategy correctly, so you only trade the best signals. We will continue using the 20 and 50 simple moving average crossover, but this time we will combine it with support and resistance breakouts for extra confirmation. Look at this chart. Here we have a clear bullish crossover signal, where the 20 simple moving average crosses above the 50 simple moving average. But the crossover alone isn't enough. We identify a key resistance level just above the price action and we wait for a breakout of that resistance. This breakout acts as our confirmation that the crossover is valid. As you can see, after the resistance is broken, the price accelerates strongly in the direction of the crossover, giving us a much higher probability trade. Now, let's look at another example. This time, the 20 simple moving average crosses below the 50 simple moving average, giving us a bearish crossover signal. Again, we identify a support level beneath the price and we wait for the breakout. After the support is broken, we get our confirmation, and that's our signal to enter the trade. Look at what happened next. As expected, the market continued moving strongly in our favor. Combining the crossover with support and resistance breakouts filters out false signals and dramatically improves the quality of your trades. Next, let's break down the Wyckoff spring signal. The Wyckoff spring happens during a ranging market after a downtrend. After a strong move down, sellers start taking profits and the market stops trending. This causes price to move sideways, bouncing between support and resistance. Once smart money has finished selling their positions, they look for a way to buy the dip, but before they do that, they need to trap more retail traders. So what happens? The market breaks below the support level, making it look like the downtrend is continuing. Retail traders panic and sell the breakout, thinking the market will crash further. But instead of continuing lower, the price quickly closes back inside the range. This move, breaking the support and then snapping back up, is called a spring. And it's a high-quality trading signal that shows smart money has entered the market ready to push price higher. Once you spot the spring, here's exactly what you do. You place your entry at the close of the candle that made the false breakout. Your stop loss goes just below the lowest point of the range to protect yourself in case the market fakes again, and your target is the next resistance level above. Look at what happened next. As expected, the market bounced strongly off the spring and went straight to the target. That's the power of understanding how smart money traps retail traders and how you can use it to take high probability trades. Now let's move to the Wyckoff upthrust. After a strong uptrend, buyers start taking profits. The market slows down and starts moving sideways, creating a clear resistance and support zone. But smart money isn't finished yet. They need to trap more breakout buyers before reversing the market. So the price breaks above the resistance level, triggering breakout trades from retail traders who think the uptrend will continue. But instead of holding above resistance, the market quickly reverses and closes back inside the range. This false breakout is called an upthrust, and it's a powerful signal that the market is ready to move lower. Here's how to trade the upthrust properly. You enter at the close of the candle that falls back below the resistance level. Your stop loss goes just above the resistance level. Your target is the next major support zone below the range. Look at what happened after the entry. As expected, the market reversed sharply and dropped toward the target, proving again that smart money always moves first while retail traders get trapped. The next trading signal is the Bollinger Bands breakout. So what are Bollinger Bands? Bollinger Bands are a popular technical analysis tool made up of three main parts: the upper band, which acts as dynamic resistance, the middle line, which is a 20-period moving average, and the lower band, which acts as dynamic support. The Bollinger Bands breakout occurs when the market breaks out of a sideways range and starts a new trend. If you can time the breakout correctly, you can capture explosive moves, often with a very tight stop loss. Now, here's how to spot a valid Bollinger Bands breakout. Step 1. Start by identifying a sideways market. Look for areas where the Bollinger Bands are squeezed tightly together. This shows low volatility and consolidation. During this phase, the price should stay within the bands, bouncing between the upper and lower boundaries. The upper band acts as resistance, and the lower band acts as support. Wait for a strong breakout candle that closes outside the bands. That candle must break above the upper band for a bullish breakout, or below the lower band for a bearish breakout. Let's look at a bullish example. We have a tight range, the bands are squeezed, and the price has been moving sideways. Then we get a solid green candle that breaks and closes above the upper band. This signals that momentum has entered the market, and this is a valid breakout setup. Now a bearish example. Again, we spot a tight sideways range. The bands are narrow, the candles are moving sideways, and price remains inside the range for a long time. Then comes the breakout. A large red candle breaks below the lower band and closes strongly. This is also a valid breakout setup, and a strong signal to consider a short entry. When used properly, the Bollinger Bands breakout strategy helps you enter the market just before trends begin, and with the tightest possible risk. Now let's move to the next trading signal, the Bollinger Bands reversal setup. Bollinger Bands aren't just useful for breakouts, they also give us high probability reversal signals. As we mentioned earlier, price stays inside the Bollinger Bands most of the time, so when price touches the upper or lower band, it often signals a potential reversal. Let's start with a sell setup. In this chart, the market is moving sideways and trading inside the Bollinger Bands. Price touches the upper band, and right after that it gets rejected and starts moving down. This is a clean reversal from the upper band. A simple and effective signal that sellers are stepping in. You can place your entry after the rejection candle, set your stop loss just above the high, and target the lower band as your take profit. Now let's look at a buy setup. Here the market is ranging again. Price touches the lower band and immediately bounces upward. That bounce shows buyers are defending the level. This is a great opportunity to go long. You enter after the bullish rejection candle, set your stop loss below the low, and target the upper band for your take profit. Now, let's make this reversal signal more advanced by combining support and resistance with the upper and lower Bollinger Bands. Look at this chart. The market is clearly ranging, trading between the upper and lower bands. Price touches the upper band and gets rejected, then moves down and touches the lower band, bouncing back up. Based on this behavior, we can draw our support level near the lower band and our resistance level near the upper band. Now, watch what happens next. As price approaches the upper band again, and also hits the resistance level we drew, it gets rejected with force. This is a clear signal that the market is likely to drop and move back toward the lower band. This kind of setup gives us extra confirmation, combining the Bollinger Band rejection with a horizontal key level. Now let's flip the setup and look at a bullish reversal. The market is still ranging, and this time price touches the lower band and bounces up. We draw our support level at that bounce area and a resistance level at the recent highs near the upper band. Look what happens when price returns to the lower band again. and also touches the support level. It rejects strongly, forming a reversal and heading back up toward the upper band. When support lines up with the lower Bollinger Band, it gives us a high-confident buy setup with tight risk and a clear target. The next trading signal is the triple top breakout. This setup is all about spotting buyer exhaustion before the market reverses. In this example, we're looking at the New Zealand dollar against the US dollar daily chart. After a strong uptrend, price starts to slow down and prints three distinct peaks. The first top forms and price pulls back. Buyers push up again, but the second top fails to break higher. Then comes the third attempt and it fails too. This is a clear sign that bulls are running out of strength. Now pay attention to the neckline, the horizontal support level that connects the lows between the tops. Once price breaks below this neckline, we get our sell signal. Enter the trade as soon as the candle closes below the neckline. Place your stop loss above the neckline. Your target is the next major support level. As you can see on the chart, once the neckline breaks, price drops aggressively. This move happens fast, because buyers are trapped and smart money steps in on the sell side. The triple top breakout is one of the cleanest reversal signals, and when you see a structure like this with three failed highs and a strong neckline break, you know it's time to act. Now let's flip the script and look at a powerful bullish reversal setup, the triple bottom breakout. Just like the triple top signals buyer exhaustion, the triple bottom shows us when sellers are running out of steam. Here's how it works. After a strong downtrend, price finds support and bounces off the same area multiple times. The first bottom forms, price bounces. Sellers push down again, second bottom. Still no breakdown. One more push from the bears, third bottom, and again, price holds. That's the signal. 3 pushes down, 3 failures. Sellers tried 3 times and couldn't break the level. That's not weakness from buyers. That's weakness from the sellers. Now we focus on the neckline, the horizontal resistance level connecting the highs between those lows. This is our trigger zone. Once price breaks and closes above that neckline, we get our buy signal. We enter the trade as soon as the breakout candle closes above the neckline. We place our stop loss below the neckline or under the third bottom. The target is the next resistance level, or a projected move equal to the height of the pattern. Look at what happens when the breakout comes. Price launches upward, buyers step in, sellers are forced to cover, and momentum takes over. This is where most retail traders are still waiting for confirmation, and you're already in the move. Let's move to the last trading signal, and this one is all about taking advantage of what's called a stop hunt to find powerful trade opportunities. If you're not familiar with a stop hunt, here's a quick breakdown. Let's say price bounces off the same support level multiple times. Naturally, retail traders start to view this as a strong level, and the next time price comes back down, many of them look to buy again, expecting another bounce. Price touches the level and bounces up, so they enter long positions and place their stop losses just below that support. But instead of bouncing again, price dips below the level, triggers all those stop losses, and then suddenly reverses back up. Okay, that's what we call a stop hunt, a move institutions use to take out weak hands before driving the market in the real direction. Now here's the key. We don't want to get caught by the trap. We want to trade with it. And here's how to do it step by step. Look for a support or resistance level that's clear and obvious. Why obvious? Because that's where most retail traders are placing their entries and stop losses, and that's exactly where smart money looks for liquidity. In this example, we can see price rejected this resistance level before, so we know traders are watching it. Now we wait for price to break above the resistance level. Once the breakout happens, don't rush in. Here's the smart part. As soon as the breakout happens, we place a limit sell order just below the key level. If the breakout turns out to be a stop hunt, price will reverse, trigger our sell order, and we catch the move down. But if the breakout is real and price continues rising, our sell order is never triggered and we lose nothing. Now we can also go a step further. We place a limit buy order above the breakout candle, just in case the breakout is genuine. So now we're ready for both directions. If it's a fake breakout, our sell order is triggered. If it's a real breakout, our buy order is triggered. Either way, we're only in the trade if price commits to a direction. Once one of the orders is triggered, we cancel the other. In this example, price broke out, then reversed and triggered our sell limit order. We immediately placed our stop loss above the resistance level and set our target at a minimum of 3 times the stop loss distance. Look at what happened next. the market dropped sharply and hit our target with precision. This is how you trade like smart money, using the stop hunts that trap others to build high probability setups for yourself. That's it for today's video. If you found value, drop a like, subscribe, and hit the bell so you don't miss the next one. Let me know in the comments which signal was your favorite, and I'll see you in the next video.